In the world of investing, power rarely announces itself loudly. It moves quietly through boardrooms, balance sheets, and long-term decisions that take years to reveal their true impact. And yet, sometimes a single name begins to surface again and again, spoken not in headlines but in hushed conversations among executives, analysts, and investors who understand what is really happening beneath the surface. Todd Combs is one of those names. For years, he operated far from the spotlight, working inside Berkshire Hathaway as one of Warren Buffett's chosen successors. He managed billions, he earned Buffett's trust, and then, unexpectedly, he made a move that sent a signal across Wall Street, a move that suggested something bigger was unfolding inside America's most powerful financial institutions. This is the story of Todd Combs, how a quiet Midwestern investor rose through discipline and patience, earned the confidence of Warren Buffett, and is now reshaping the investment strategy of J.P. Morgan, one of the most influential banks in the world. To understand why this matters, we need to go back, not to Wall Street, but to a mindset. Todd Combs was never a loud investor. He did not build his reputation on bold predictions or television appearances. Instead, he built it on numbers, probabilities, and restraint. Raised in a modest household, Combs developed an early fascination with finance that was rooted not in excitement, but in understanding how systems work. He studied economics and finance with intensity, absorbing the principles of value investing, buying strong businesses at reasonable prices and holding them for the long term. After graduating, Combs worked his way through the financial world quietly, eventually founding Castle Point Capital, a hedge fund that would come to attract attention not for massive risk-taking, but for disciplined performance. While others chased momentum, Combs focused on balance sheets, cash flows, and downside protection. It was not flashy, but it was effective. That approach caught the attention of Warren Buffett. In 2010, Buffett made a rare decision. Recognizing that Berkshire Hathaway would one day need new stewards, he hired Todd Combs to help manage the company's massive investment portfolio. It was an extraordinary endorsement. Buffett was known for trusting very few people with capital, especially capital measured in tens of billions of dollars. Combs did not arrive to replace Buffett. He arrived to learn, and more importantly, to prove that the Berkshire philosophy could survive beyond its legendary founder. Inside Berkshire, Combs was given responsibility over enormous sums of money, investing independently but within the strict discipline that defined Buffett's legacy. He focused heavily on financial institutions, insurance companies, and businesses with predictable earnings, industries where risk could be measured, not guessed. Over time, Combs became one of the most influential decision-makers at Berkshire Hathaway. He also took on a leadership role at Geico, Berkshire's insurance powerhouse, gaining operational experience that went beyond stock picking. He was learning how businesses actually functioned, from underwriting to regulation to capital allocation. But while Combs was building his reputation quietly, the financial world around him was changing. Banks were transforming, technology was reshaping finance, regulatory pressure was increasing, and competition for capital was intensifying. J.P. Morgan Chase, under the leadership of Jamie Dimon, had emerged as the most powerful bank in America, profitable, diversified, and deeply embedded in global markets. Yet even J.P. Morgan faced a future filled with uncertainty. Interest rates fluctuated, fintech threatened traditional banking models, geopolitical risk returned to the global economy. Capital allocation decisions would become more critical than ever. That is when Todd Combs entered the picture again, this time not as a quiet partner at Berkshire, but as a strategic force inside J.P. Morgan's evolving investment initiatives. When news broke that Combs would take on a leading role in a new strategic investment effort tied to J.P. Morgan, markets paid attention. This was not a routine hire. This was a signal. J.P. Morgan was not just looking for growth, it was looking for judgment. Combs brought something rare to the table, the Buffett mindset applied inside a modern financial institution. Where many banks chased short-term returns, Combs emphasized long-term capital discipline. Where others leaned into complexity, he favored clarity. His approach focused on sectors that aligned with enduring economic needs: energy infrastructure, defense, healthcare, and financial services that could withstand cycles rather than ride them. This was not about chasing the next trend. It was about positioning capital where the world would inevitably need it. Inside boardrooms, this philosophy began to shape discussions. How much risk was acceptable? Which investments truly compounded value over decades? How should capital be protected during downturns, not just expanded during booms? Combs understood something many investors forget. Survival is the first rule of compounding. His influence also reflected a broader shift happening across global finance. After years of speculative excess, investors were returning to fundamentals. Cash flow mattered again. Balance sheets mattered again. Risk management was no longer optional. Todd Combs represented that return to discipline. Yet his story is not simply one of conservatism, it is one of adaptation. Combs is not frozen in the past. He recognizes that technology, data, and scale have transformed finance. But he applies those tools within a framework grounded in rational decision-making. In many ways, he bridges two worlds, the old guard of value investing and the new era of global finance. That is why his role inside J.P. Morgan matters beyond a single institution. It reflects a broader realization across markets that capital must once again be guided by experience, patience, and accountability. For Warren Buffett, Todd Combs was never meant to be a clone. He was meant to be a continuation. Someone who could carry forward a philosophy without turning it into a rigid doctrine. For J.P. Morgan, Combs represents something slightly different, a stabilizing force, a reminder that even the most powerful banks must think like long-term owners, not just operators. As markets move into an era defined by uncertainty, geopolitical tension, technological disruption, demographic shifts, the importance of disciplined capital allocation will only increase. Investors are watching not just what companies earn, but how they deploy capital when conditions change. Todd Combs operates precisely at that intersection. His career offers a lesson that extends beyond J.P. Morgan or Berkshire Hathaway. It reminds us that influence in finance is not built through noise, but through consistency, through decisions that may seem unremarkable in the moment, but transformative over time. In a world obsessed with speed, Combs represents patience. In a market driven by narratives, he represents numbers. And in an era of uncertainty, he represents a philosophy that has survived crashes, bubbles, and decades of change. The reshaping of J.P. Morgan's investment strategy is not about headlines, it is about direction. And in finance, direction often matters more than momentum. Todd Combs may never seek the spotlight, but his decisions will continue to shape where trillions of dollars flow and which institutions endure. And that, in the end, is the quiet power of the investor who learned from Warren Buffett and is now writing his own chapter in financial history.